Hello and happy Wednesday, May 13th. Welcome to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates, among other news. Today, the markets are down. They are down on news that the economic outlook is more uncertain. Fed Powell made a speech that talked about the recovery could take longer than expected. So the stock market did react to that news. On the bright side of things, the crude oil remains for the futures in the $25 a barrel range. Not bad. Good to see that trend to continue. We have seen the U.S. 10-year Treasury yield today trading at the 65 basis point range. That's 0.65. So that's come down a little bit, tightened up a bit. Both agency and FHA rates are flat. So the FHA 223F rate is quoting at 2.55 today. That is 2.55. And the 221D4 rate is now quoting again at 3.20. That is 3.20. Over to the Fannie Mae DUS loan, we are talking about a 10-year fixed rate at 3.20 still. And still on the Freddie Mac, looking at the 3.20 to 3.35, just like it was yesterday. That's why we call it flat. Next, I want to talk about a couple of things, mainly associated with how long will this recovery take and what are some officials at HUD looking at, as well as other types of groups. There's a national investment fiduciary group, and they are looking at not just the short-term impact on rental housing of the slowdown, economically speaking. They want to look at the long-term impact. What does that mean? Well, that means that they're not looking at the short-term rental growth or, lease up, although they are looking at that as capturing fully what the slowdown means. That means they're looking out 12 months and maybe beyond, but for sure, I feel like right now 12 months is really the right number that economic folks and underwriter officials and people like that are really putting their heads together and saying this 12-month period should capture what we consider an unusual slowdown economically speaking, okay? So when you're doing your modeling and you're thinking about your properties, 12 months I think is more the right number that you're gonna see from different lenders, or when you're just trying to model out how long this impact could carry on. Next note is kind of obvious, but the properties that are high service employee tenant residents are greater impacted. I don't think that's always the right mix to just look at the class of the property and associate that with the resident pool. Although I feel like there is a bias towards considering Class C properties are going to be heavier hit than say Class A properties. That might be generally true as a rule of thumb, but of course it's always case specific, it's market specific, and it's location specific, right? So if it's urban, and you might have a lot of studios, it could be a Class A property that does have a lot of service tenants and residents in it as well. So something to consider there. And last thought of the day, when you're acquiring a property, in the old days, there were very tight purchase timeframes, right? You had the seller really in the driver's seat saying, we're gonna close this thing in 60 days or 90 days, or they were really dictating those terms. Now, there's more flexibility around financing. What does this mean? This means that if you're a borrower, you have more options on your financing. HUD, FHA loans, as you may know, take longer to process, and that used to automatically just rule them out to be used as an acquisition loan. But guess what? If you've got financing and you want to buy a property in today's market, those sellers are going to work with you. I'm seeing it. Other lenders are seeing it. It's something to think about, and it really helps put buyers and borrowers into the driver's seat. And finally, what is the best mitigant to uncertainty? That's right, cash. Cash is the best mitigant to uncertainty. So again, if you've got properties, you're sitting on trapped equity, now's the time to consider accessing that, tapping that, holding that down for this 12-month time frame. That's going to put you in the best possible position as we pop out of this thing and go right back into a growth market. That's all for today. This has been another episode of Rate Desk. This is your host, Michael Thomas, signing off.